Welcome to the Deep Dive. We're the place that, cuts through the noise to get you the essential insights from some pretty complex information. Today, we're doing a fascinating deep dive into the recent financials of a real media giant, the New York Times Company. We've got their Q2 2025 earnings call transcript, the press release, SEC filings, the whole stack to really pull out the important stuff for you. Our mission today: understand how this, legacy brand isn't just surviving, it actually seems to be thriving in this fast-changing digital world.
Exactly. We'll be digging into their key results, their strategic moves, especially around content and product, and importantly, how they're using new tech like AI to keep that growth going. This deep dive should give you a real shortcut to understanding how one of the biggest news organizations is, planning its future. There's some surprising bits in here, too.
Okay, let's get into it then. Let's unpack this, diving right into the core. The CEO called it a great second quarter across the board. He said their strategy continues to work as designed. What does that actually mean in tangible terms?
Well, in simple terms, it means growth everywhere. All their main revenue streams, subscriptions, advertising, affiliate, licensing, all up. To put some numbers on that for you, total revenue climbed 9.7% compared to last year, hitting $685.9 million, and their operating profit, that surged over 34% to $106.6 million. Adjusted operating profit also jumped almost 28% to $133.8 million. What's really interesting, I think, is the margin. Their adjusted operating profit margin expanded significantly by about 280 basis points, reaching 19.5%. That's a solid jump, shows better efficiency. And all this generated good cash flow, $193 million free cash flow in the first half of the year, which, lets them reinvest but also return cash to shareholders. About $134 million through buybacks and dividends.
Wow, okay. So quite healthy then. What does this picture tell us about the company's sort of underlying long-term health? It really sounds like a solid foundation.
It really does. I mean, these aren't just blips on the radar. It points towards sustainable growth, especially as they dig deeper into digital. It really validates their big shift, moving from relying so heavily on ads to this subscriber-first model. It shows that quality content, even niche stuff, can still get people to pay directly. It's almost a playbook, really, for other older media companies trying to figure out digital.
Yeah, that makes sense. And that leads us right to the engine driving the subscriptions. So the company added 230,000 net new digital subscribers just in Q2. That brings their total digital-only count to around 11.3 million, getting closer to that big 15 million goal they've set.
Right. And connecting that to the bigger picture, a huge milestone this quarter was hitting over 50% of their subscribers on the bundle or multiple products. So that's 6.02 million out of the 11.3 million digital-only subs. This really highlights a key shift in how media makes money now, moving past just selling one thing to these stickier bundles. It's just a smart way to boost lifetime value, keep people around longer, especially when it's so competitive online. Engagement is everything. And the revenue shows it. Digital subscription revenue was up over 15%, hitting $350.4 million.
And what about what each subscriber is actually paying? Are they getting more out of each person?
Yeah, they are. Their ARPU, the average revenue per user for digital only, it grew 3.2% to $9.64. Now, a lot of that comes from moving people off those cheap introductory offers onto higher prices, and also some targeted price increases for long-term subscribers. It's always a tricky balance, right? Raising prices but keeping people happy. Which begs the question, how are they adding enough value to justify that, to keep people engaged?
That's a great question. And their priorities for the year seem to give us some clues. They're focused on, ambitious coverage of big news stories, obviously, but also making reporting more accessible video audio and making each product better. New content, new shows, features, games. They also mentioned a new family plan is starting to roll out. Early days, but it's there.
And the video expansion is a really prime example of that value add. They're scaling it up fast. Sort of three main areas. More news videos with reporters actually on camera. Full-length shows, like video versions of popular podcasts, Ezra Klein's show, Ross Stoutman's Interesting Times, and then enhancing lifestyle stuff with video, the athletic sports highlights, new video series on cooking. And they're saying these efforts are already showing promise, getting traction on video platforms and improving their own site and app experience. It's kind of like watching, a transformation, isn't it? The Times, once just print on your doorstep, now really pushing into digital video.
It really is. But while digital's booming,
Yeah.
what's happening with print?
Well, print subscription revenue, that decreased, down 2.8% to $131.1 million. And print subscribers dropped too, a net decrease of 40,000 compared to last year, which, just reflects those ongoing trends we see everywhere. No surprise there.
Okay, shifting gears then. Advertising. They called it a really strong quarter there, too. Digital advertising grew almost 19% to $94.4 million. Total advertising up over 12%. 19% growth in digital ads. That sounds really impressive, especially with all the headwinds you hear about in the ad market. Is this just the market getting better, or is the Times doing something specific that's working really well?
It definitely seems like they're doing something specific. Their whole strategy for building a bigger, more durable digital ad business seems to be paying off. They're using their whole portfolio of brands, especially in lifestyle areas like sports and games, which appeal broadly to marketers alongside the core news. They have this huge engaged audience, right? And they can target them effectively using their own first-party data. They even mention an AI tool, Brand Match. Plus, they've expanded their ad products, adding new formats that can be sort of rolled out quickly. That helps when the market feels uncertain.
They certainly sound positive about it, saying they have a lot of running room ahead in advertising. But what about potential risks or, challenges that could maybe slow down that running room they see, especially with digital marketing always changing? And what about other revenue streams?
That's definitely the critical question. I mean, the whole ad market is volatile and privacy rules keep changing. That's a challenge for everyone. But their focus on first-party data and those direct relationships probably gives them more resilience than some others. Beyond ads, their affiliate, licensing, and other revenues were also up, a healthy 5.8% increase to $70.5 million. And what's really fascinating in that bucket is this new multi-year deal they signed with Amazon in Q2. They explicitly called it their first agreement with generative AI at the center.
Okay, that Amazon deal does stand out. A legacy news company partnering so closely with a tech giant like Amazon, especially involving AI. Doesn't that raise questions like about editorial independence or control over their own content? How do they square that? What makes it worthwhile?
Those are absolutely the right questions. And the company was pretty clear on their stance. The deal basically brings Times journalism, recipes, athletic coverage to more people across Amazon's different products and services, including their AI models. But, and this is the important part, they stressed it aligns with their long-held principles. They said it provides fair value, it gives them control over how their IP is used, and it fits their strategy of making the Times more essential to more people. It really backs up their belief that their journalism is valuable, that it's worth paying for. Seems like they structured it carefully to protect their independence while still getting wider reach.
Interesting. Okay, looking at the operational side now, they talked about cost discipline, but still investing in journalism and product. Adjusted operating cost grew 6.1%. But it wasn't all smooth sailing on the cost front, right? They had some significant legal costs tied to AI.
Indeed. Yeah, they spent $3.5 million just in Q2 on litigation related to generative AI. It's part of that lawsuit against Microsoft and OpenAI, alleging they unlawfully copied and used Times journalism to train their AI models. Now, some claims got dismissed, like unfair competition and DMCA, though they might refile the DMCA claim. That's the Digital Millennium Copyright Act dealing with online copyright. But other key claims are moving forward. And this legal fight, it's not just about the $3.5 million, it's really a bellwether case. The outcome could fundamentally change how AI models get trained using copyrighted stuff. It could set a huge precedent, globally really, for IP rights and creative industries in this AI era.
Oh, and just a structural note. They plan to move to a single reportable segment next quarter, putting the New York Times Group and The Athletic together for reporting. Make things clearer internally, I suppose.
So given all this, the growth, the investments, but also the legal battles and the shifting media landscape, how confident did they sound about continuing this growth? They sound very confident. Despite, the challenges from big tech platforms sometimes sending less traffic to publishers, their confidence seems rooted in what they call a large and persistent demand for their specific content. And that focus on building direct, engaged relationships with millions of people who actively come to them for news and products, that direct connection, they believe, is what powers everything, all their revenue streams.
And looking just ahead to Q3 2025, their guidance seems to reflect that optimism.
It does. They're expecting digital-only subscription revenue to grow 13–16%, digital ad revenue up low double digits, affiliate, licensing, and other revenues up high single digits. So overall, they're forecasting healthy growth in revenue and adjusted operating profit, further margin expansion, and strong free cash flow for the whole year.
This has been a really insightful look at how the New York Times is navigating things. It's more than just adapting, isn't it? So if you had to boil it down, what's the single biggest takeaway for our listeners from this deep dive into their strategy and performance?
I think what we've really seen here is a company that's not just reacting to change, but actively trying to shape it. It's driven by that strong digital subscription growth, yes, but also smart diversification, the push into video, for example, a resurgent ad business that's using data cleverly and new ad products, and these innovative but principled partnerships like the Amazon AI deal. Underneath it all is this conviction. Quality journalism and direct, engaged audience relationships are the path to long-term profit.
Right. So as New York Times keeps redefining what a modern media company looks like, embracing AI, embracing video, what does their success tell us? What does it say about the future value of trusted journalism, of those deep audience connections in a world that just feels increasingly fragmented online? What really stands out to you about how they're managing this whole transformation? Something for you, our listener, to think about.